Good afternoon, ladies and gentlemen. My first conference call with you all. So I think you should all be mindful of the fact that this is my first call. With that, I'll start off. Welcome to Dabur India Ltd's conference call pertaining to the results for the quarter and year ended 31st of March 2019. Dabur's consolidated revenue grew by 11% during the financial year 19. Domestic FMCG business recorded a growth of 13% in financial year 19, driven by a double-digit volume growth of 11%. All the three verticals of healthcare, home and personal care, and foods recorded a strong growth led by investments in brand building, distribution expansion. International business reported a growth of 6.5% during the year and was impacted by macroeconomic headwinds in the MENA region and adverse currency movements in markets such as Turkey and Pakistan. Before we move to the quarterly performance, I would like to give you a perspective of our long-term strategy since I take over as a business head. The overarching theme for Dabur is to strengthen the long-term health and competitiveness of our brands and to grow ahead of the market in order to gain share across categories. Investments will be concentrated on power brands such as Dabur Amla in hair care, Dabur Red toothpaste in oral care, Real in the beverage and the food space, Dabur Honey in the honey category, Chyawanprash, and other three scalable Lal Tel, Pudina and Honitus brands with disproportionate investments that shall be made. This initiative is already yielding positive results in all the three brands wherein we disproportionately invested with strong double-digit growth during the year. Lal Tel has registered a growth of 15%, Pudina 21%, Honitus grew by 17%. In order to drive innovation agenda, power brands will be extended into adjacent areas in order to leverage their strong brand equity and consumer connect. Further, in consumer health, we have a large ethical Ayurvedic portfolio which would be transitioning some prescription brands to the OTC portfolio, and once the OTC brands become larger, we will extend them to the larger FMHG, which is fast-moving health goods space. We would leverage our brand strength and R&D capability to pursue these healthcare initiatives since there is a significant headroom due to low penetration and lower competitive intensity in the Ayurvedic space. To support our brand building initiatives, we have undertaken projects to increase efficiencies in front-end and back-end supply chains in both India and international business, which will help the company become leaner and more efficient in the future. On the people front, we are creating a more engaged, agile, and accountable organization. People are the key pillars of the organization, and we have a strong internal talent pool, and we are supplementing the same with talent development and experienced external hiring. The management remains optimistic about the future of the company. Now coming to the Q4 financial year 19 results, consolidated revenues from operations grew at 4.7% in Q4 financial year 19. Domestic FMCG business recorded a growth of around 6% on back of volume growth of 4.3%. Excluding fruits, the value growth was 8.5%, backed by a volume growth of 5.5%. Growth was slightly lower than the previous quarters due to prolonged winter season and a general slowdown in demand due to agrarian distress and liquidity crunch. Healthcare vertical performed very well with a growth of around 11.2%. Health supplements grew at 10.2%, led by double-digit growth in Chyawanprash. Digestives category recorded a growth of 11.9%, driven by continued strong performance of Hajmola tablets and Pudina. New variants, focused marketing inputs, and distribution expansion contributed to driving this growth. OTC product categories grew at 16% on back of good growth in Lal Tel and Shilajit. Ethical business delivered a growth of around 10%. HPC vertical posted a growth of 6.8%. Toothpaste grew at 9.3% during the quarter. Red franchise continues to perform very well with increased penetration, aggressive marketing, and visibility initiatives. Dabur remained under pressure due to high competitive intensity at economic price points. In spite of our value market share in toothpaste category, our value market share in toothpaste category increased by 45 basis points year on year. The hair care portfolio was impacted by demand slowdown and prolonged winters in the North India. That said, our market share in hair oils moved up by 70 basis points vis-a-vis same quarter last year. Also, our market share in shampoo category increased by 64 basis points. Skincare registered a growth of 11.2%, driven by double-digit growth in Gulabari and good performance of the bleach portfolio. Home care category grew at 16.2% in this quarter, backed by strong performance of Odonil and Sanifresh. Odomos recorded a subdued performance on account of low incidence of mosquito-led diseases. Food business recorded a decline of 5.9%, mainly on account of prolonged winter season, which impacted our largest market, that is North India. The ethnic masala range launched during the year in the modern trade has received a very positive response from the consumer. Encouraged by this, we are now rolling it out to general trade across the country and are adding few more variants. Our market share in the J&N category has increased by 540 basis points over the same quarter last year, touching the highest peak of around 56%. We believe the dip in this quarter is temporary and the business will come back on growth track in the coming quarters. International business recorded a growth of 1.9% during the quarter. SAARC grew by 8% on the back of strong growth in Nepal, Bangladesh and Myanmar. Turkey had a strong quarter, growing by 40% in constant currency terms. However, currency devaluations impacted the translated revenues. MENA markets continue to remain under pressure. However, we have seen our market shares increasing in almost all the categories across the key markets of Saudi Arabia, UAE and Egypt. During the quarter, profitability was impacted by exceptional item and one-offs. Growth in the PAT, excluding the exceptional items and one-offs, was 4.6% in line with the top line. While the media spends have come down in quarter 4, the overall marketing spends, including trade and consumer promotions, were higher, particularly in India business, where the total ad pro went up by around 4%. A&P spends on power brands have, on the other hand, increased in double digits. Going forward, we'll continue to invest strongly in our brands, distribution and infrastructure to enhance our visibility and market shares. In spite of challenges in some of our markets, we will continue to drive the business based on strong innovation pipeline, distribution expansion and enhanced A&P spends. Our endeavor will be to continue to build strong and sustainable enterprise backed by a brand portfolio which resonates with consumers and offers superior products to delight them. With this, I open the session to questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Thanks, sir. My first question is on market share data in some of the segments. For example, your share has improved in most of the segments, but in skin, home, OTC, ethicals and digestives, wherever you have the market share, is it possible to share how YOY performance has been?
Abneesh, in home care and in the skincare segments, our market shares have actually gone down. And we will send you the exact numbers, but there the market shares, while the category growth rates have been very high in excess of our growth rates, market shares have actually gone down in home care. In skincare, we've surged ahead in terms of market shares, much ahead of the category, which is in the Gulabari space. In OTC segments, we don't have market share data available with us, but we have our consumer panel data, and consumer panel data shows that we've actually increased our market shares here. The exact market share numbers can be shared with you.
And sir, where your market share has improved, are you seeing direct correlation with growth also? Because you mentioned in 2 of the segments you have seen a dip in market share, but your internal growth has been quite good. So in where growth has happened and market share has improved, is there a correlation?
Yeah, there is a different correlation in all of the segments. We see the oral care, like red toothpaste, has grown by around 17.5%, and there our market shares have actually improved by around 45 basis points. So there's a direct correlation there. In hair oils also, we see a growth coming, and the market share data shows an increase of around 70 basis points there also. But I think in the skincare segment and the home care segment, the market is actually surging much ahead of our growth rate. While we've grown at around 16%, but the market, I think, is growing at around 20% odd. That's why our market shares have actually dipped here. And these are not our power brands also, as we stated earlier. So we are very happy with the kind of growth rates that we have here, and we are working towards increasing our market shares and growing ahead of the category growth rates.
In 2 of your cost items, more clarity if you can give on consultancy cost and GMP. GMP, why is it required now? Was it for the new factory?
No, so I think there are 2 elements. We always have the GMP as the improvement areas to have the good manufacturing facilities. We have made expansions, as you know, in Tejpur, so therefore there is some expenditure required on the GMP side there. The other part is also wherever we have an export under the US FDA rules, we need to upgrade our manufacturing facilities. In order to meet that, there are expenditures which are required to be incurred. So these are the expenditures that you see on the revenue side on account of GST.
And consultancy? What was it for?
Sure. So what we have done is we have taken a project Lakshya to improve our supply chain network during the last financial year, and therefore this periodical expenditure that we have talked about is on account of the consultancy that we have paid in order to have the design and the implementation of the supply chain improvement networking. So that's the cost that we have incurred incrementally this quarter.
So my next question is on the international business, this write-off of 75 crores in terms of the goodwill. Is it only because of currency devaluation? Because currencies can be volatile. You take a goodwill write-off based on fundamentals of the business more likely. So if you could update, is it also because fundamentally the business is looking far tougher than when you had acquired?
See, as far as we talk about the local currency business, we have grown almost 40% in this quarter and around 28% for the year. And if we were to look at even in terms of our overall CAGR, our growth has been close to 20% in top line and around 25% in PAT. So I think on the local currency, local market side, we have been growing pretty well since inception. It's just the currency devaluation which has impacted the investments that we have made into this acquisition required for the impairment, and we have done the impairment testing in accordance with our accounting standards. And considering the fact that in this particular year, the last year, there has been currency devaluation to the extent of 40%, that had required us to make a provision on account of impairment of goodwill to the tune of approximately 75 crores, 75.3 to be precise.
And so last question in terms of pricing and promotion, in the past you have said your strategy is to match any aggressive competition. So in Babul and fruit business, in Babul you have seen multiple quarters this issue being there. So are you not going to take action there in terms of matching competition? And in fruit business, I see you have done a lot of promotions. So are your promotions in line with the competition?
Abneesh, promotions are pretty much, as far as the food business is concerned, we've been matching up competition with the promotions and tactical trade inputs also, and you can see the results as far as market shares are concerned. We've already, the highest ever market share is there, and that's the result of these tactical promotions. As far as other categories are also concerned, we will keep shoring up our tactical trade and consumer activity to match up with the competition to ensure that we surge ahead of the competitors in the marketplace.
Okay, Mohit, that's all from my side. Thank you.
Thank you.
Thank you very much. The next question is from the line of Vivek Maheshwari from CLSA. Please go ahead.
Hi, good evening, Mohit.
Hi, Vivek.
Hi. Couple of questions. First, on your outlook on demand for FY20.
Right. So demand, we've actually seen across categories a little bit of demand slowdown happening in the quarter four, and that's evident through the Nielsen data and all other syndicated data indicators also. We see there was a demand, FMCG growth rate was around 15.9%, it's down to around 13.6%. If you see the exit rates also, they are in around 10% odd levels. If you look at volume growth rates, which were around 12%, now we see down to around 10%. If you look at the exits of March, they are in the range of around 7%. There's definitely demand slowdown that we would witness, and I think one of the reasons could be maybe agrarian distress, the lack of stimulus actually reaching the consumers, unemployment being all-time high, and a lot of other macroeconomic factors. That being said, our business got impacted because of more winter seasonality, where the beverage category also declined by around 3%, but the syndicated data shows that we've grown by around 6% in terms of secondaries and tertiaries, while our primary business is down around 5.9%. So I think for us, it's a temporary blip in terms of winter seasonality. That's why the business is down. Hopefully, we should be able to recover in the first quarter of the current fiscal year. I don't think any structural or fundamental problem in the business.
Okay. And on the margin side, how do you there has been some bit of a pullback in FY19 on the margins. What do you think happens as we head into FY20? Would you want to protect margins at this level, or is there any expectation of an expansion, or it can even slide down further?
So if you look at the India business, our margins have been more or less stable. The gross margins are pretty stable. I think the cost of the raw material has been benign, and whatever little inflation was there that was set off by the price increases that we could easily take. We want to maintain the margins going forward across categories. We don't want to dip the margins, or there will not be any margin expansion. In case of any cost efficiencies that accrue to the business because of the Lakshya project that we embarked on, we'll be plunging them back into our A&P spends and trying to shore up the volumes rather than increase the margins. So therefore, maintenance of margins is that we want to consider.
And I just want to add that, where you see there is a decline in margin are two accounts. One is the one-off expense in the operating margin that you see on account of the employee cost going high on account of ESOP, which probably going forward that one-off adverse impact may not be there. The second is on account of the deep devaluation in some of the markets like Turkey, Pakistan, Nigeria, etc. There has been a pressure on the margins on account of transaction exchange impact, which will get rollover once the 12 months period is over, but that will depend whether there is no further devaluation happening. So that's where the exchange will also have an impact on the margin. But going forward, if there is no steep devaluation, we may not have that impact, but if it happens, there would be some impact on account of that.
Okay. And quickly on the staff cost, so from first quarter FY20, is the base reset, or this exaggerated impact will continue for in the first half?
Sure. So I think going forward in FY20, there will not be that extended impact happening in the next financial year. This was one-off case because of the low base in the last fiscal year where we had reversed some of the ESOP amount, and at the same time, because of the rate difference between the previous vision rate and the current vision rate, we saw in FY19, 18-19 financial year, the adverse impact. But going forward, it will not be continuing because it will get evened out, and in fact, on some extent, in view of the amortization basis, it may be slightly lower, but at least it will be at a similar level or slightly lower, but it won't be on the higher side.
It actually may give us a benefit going forward next year, because in terms of the ESOP scheme that we have a higher amortization of around 29% in the first year, goes down to around 26%. So that will actually add to a benefit going forward. And last year was the closing of our internal vision period, which is the fourth year of our vision period. Because of demonetization, we did not do our numbers. Therefore, we had to reverse the stock options. That's why the base was higher there. And that's why you see the lower there, and that's why you saw the growth in the current year, which is around 33% growth in the staff cost that you saw. So it will not happen after this quarter. It's only a one-off case.
Sure. And my last question is on the India tax rate. When does it hit to the marginal level?
Well, I think as far as our tax rate is concerned, it has always been as per the MAT rate. However,
right,
in view of the accounting standards, we had to take the credit of the MAT in this fiscal year. So if you see that in the current quarter, we have taken the credit on account of reasonable certainty as per the accounting standards, and therefore you see the rate is lower than 20%, which is the MAT rate.
Right, but when do you get to marginal? Sorry, please go on.
But our MAT rate will continue for around 9 to 10 years going forward. So I don't think there is 5 years going forward.
It is still 25,
26.
Our effective tax rate will continue to be close to the MAT rate, around 22%.
Yeah.
For next 5 years?
Yeah.
Perfect. All right. Thank you and wish you all the best.
Thank you, Vic.
Thank you. The next question is from the line of Prakash Kapadia from Anived PMS. Please go ahead.
Thanks for taking my question. Mohit, you articulated, focus on power brands. As we step into FY20, if you could, give us some sense on pecking order of growth, say between foods, healthcare, and, home and personal care, because, we have a large, product range and some of the power brands are big enough. So if you could give us some sense in some categories, that will be helpful.
See, in the HPC space, definitely our focus area is going to be the hair oil category, and that's where we think the growth is going to come from. Then there will be healthcare and also food. So in the pecking order, it will be more personal care first, followed by then hair care, and then the foods. And within the personal care, there is hair care and also oral care. Hair care number 1, oral care may be number 2, and third will be healthcare, followed by foods.
Okay. And hair care will be driven by premiumization, or because that's a fairly penetrated category?
Yeah, see, there are both ends to the growth potential and the growth pillars. One will be premiumization. Premiumization will be more margin accretive for us, and the launch will be more in the e-commerce space and the modern trade space. But the volume growth will really come from at the lower end, targeting the bottom of the pyramid, and therefore LUPs in the 10 rupee price points will be the ones which will be the instruments with which the growth will be leveraged going forward.
And, in the release as well as, in your opening remarks, you did mention about Dabur Red doing exceedingly well. Now, I would guess Dabur Red would be more than 2/3 of our business. So, has Miswak also degrown? Babool, you did mention, is facing challenges. So, what's the roadmap for Babool and Miswak? And Dabur Red would be what now? 70% of our value sales?
Yeah, Dabur Red should be around 70-75% of the overall value. Going forward, Miswak is not declined. Miswak is actually grown by around low single digit growth rate. But as far as Babool is concerned, there is definitely a pressure in Babool, and it's a large franchise of more than 100 crores for us. We are definitely going to be revamping the entire brand going forward. So I think end of this quarter we should be seeing a relaunch of the Babool franchise.
And lastly, on honey, what is happening in healthcare? We've done, well for the year as well as the quarter. Quarter obviously would be more because of Chyawanprash. So, honey, what has happened during the year? What are we seeing as, market share gains continuing for us? Any plans or new launches, if you could give us?
Yeah, honey is doing exceedingly well. We've been able to gain the entire lost ground that we lost to Patanjali. We are back into the market growth rate. The overall year's growth should be greater than around 20% as far as honey is concerned. So, and we've launched a new squeezy pack, which has also done reasonably well. So, honey, we are back on track completely. Chyawanprash also continues to do well, and in the current season, glucose is also doing reasonably well. So, health supplement portfolio, along with OTC portfolio, all of them are doing reasonably well for us. But that being said, in the current quarter, because of the very high base of honey last year, we saw a single-digit growth rate in honey. That is on account of a little bit competitive pressure from smaller players like Apis and Hitkari. But we are mindful of that, and we are taking steps tactically through consumers and trade promotion to counter that.
However, having said that, Chyawanprash did very well in this quarter and grew the growth of health supplement category to a good level.
Sure. Thank you. I'll come back if I have more questions. All the best.
Sure, thank you.
Thank you. Next question is from the line of Prasad Deshmukh from Bank of America. Please go ahead.
Hey, good evening, Mohit. Just a couple of questions. Firstly, in the international business, what is your plan to revive growth mainly in Middle East and also in the Namaste part of the portfolio?
Right. So I think as far as Middle East is concerned, there are definitely macroeconomic headwinds and geopolitical headwinds that you guys are facing, and it's been a long time that we've been facing that. I think there should be another 1 quarter of pain that we see, which should be the first quarter of current fiscal year. From next quarter onwards, we should see the growth revival because we lap over the high base there, and we will see the growth revival. Now, as far as fundamentals are concerned, there is a definite pressure in the Middle East. We see most of the categories in the personal care space that we operate in, which are declining the double digits. That being said, our market share gains across the categories, the shampoo, hair oils, toothpaste, continues to gain traction, and we've increased market shares by 2 to 3% in the MENA region. So I think Middle East should be back on the growth path, high single-digit growth path from second quarter onwards. But we don't see any abatement in terms of the macroeconomic headwinds in the Middle East. Do we see a category revival? The answer is no. But I think based on our innovations and investments in media, we will continue to steer the course on innovations and media investments, and the growth path will start. Inherently, the business is exceedingly profitable and the largest chunk of our business, and our brands are household names in the Middle East. As far as the Namaste business is concerned, we expect the North America business to trend at a single digit, but on a growth path. Unlike last year where we actually declined there, but I think we should chart back a growth path there. There are category headwinds in terms of the chemical and the relaxer category declining double digits, and we are the major players in the relaxer category. We've launched a lot of new products in the natural segment, early days yet, to see see or to comment or make a judgment on how the new products in Namaste are actually doing. So North America domestic business, we expect low single-digit growth rate in the hard currency. In other market of Sub-Sahara, which is where the real price of Namaste products are, there we will continue to grow at double-digit. And if the currencies do not devalue there, we will see the translation gains also coming in if we lap over the currencies. That is as far as Namaste. So overall, Namaste business should grow at a single digit, also maintaining the margins, operating margins there.
Okay. And second question on, you mentioned about power brands being extended to more and more part of the portfolio. But does this mean that there will be defocus on some of the brands which probably may not be having too much of scalability potential? Or power brands is like a separate budget for you?
No, as you see, the Dabur's got a very diversified portfolio, so you have to actually prioritize on where you put the money and the limited amount of resources. So within the resources available to the company, we have to prioritize. So therefore, power brands are the ones where we see the maximum potential and the headroom for growth and low competitive intensity. So we are actually, those are the kind of power brands which we're going to scale up to a level of maybe 1,000 odd crore level, so that we can leverage those brands in other areas. But we should not be not focusing on the other part of the portfolio. When I say focus on these power brands, that means disproportionate investment will be going behind it. We'll be subsuming a lot of brands under the power brand architecture and extending them so that we are able to scale them up. For example, a haircare business, which is a 1,200 crore business, has the potential of scaling up to around 5,000 odd crores. So how do we scale that? This will be scaled up through a Amla franchise. That is a power brand that we have. For example, we have a real franchise. Rather than splitting the money among Volo or coolers, etc., we will focus all our energies behind real and try to grow real beyond 1,000 crores to a level of maybe 2,000, 3,000 crores, because it operates in the category of around 10,000 crores as a drink. And there's a huge potential and equity of the brand which hasn't been yet harnessed and leveraged. So I hope I've been able to answer the question. That doesn't mean that we'll defocus on home care or skin care, which are the brands there in the portfolio. That investments will be in line with what the P&L of the brand can actually afford. There'll be no disproportionately high investments there.
Got it. Just one last question then. What was the growth in modern retail channel in Q4, and any update on your partnership with Amazon?
See, modern trade for us is growing at the rate of around 19% broadly, which is much ahead of us. And modern trade is also going to be a thrust area going forward, because we think this is a window into the GT and also an incubator for all of the NPDs that we will want to roll out eventually. So, and e-commerce, the business has grown overall. If you see the full fiscal year last year, we've grown by around 100% in e-commerce, albeit on a lower base. But then the growth has been tremendous. And next year also we're taking a very ambitious target, and we want to drive this growth. And to augment this, we've also inducted the vertical head for e-commerce, who will be working as a P&L head to drive that kind of a growth. Next year, last year in the beginning, we started off with e-commerce being 0.8% of the business. It's already touched 1.2%. Next year, 1.4%. And next year, we want to project it to go up to around 2.2 to 2.3% of the overall turnover. And this will also be an incubator for a lot of the NPDs that will be rolling out, which will be exclusively for the e-commerce. Amazon happens to be our largest partner in the e-commerce among all the customers that we interact with, all the platforms. Amazon is number one, followed by BigBasket and Paytm, etc. In the last quarter, we had a little issues on Paytm because they stopped giving freebies and cashbacks on their platform. That's why you see a growth, not 90% in e-commerce, but in the range of around 60-odd% in the last quarter.
Okay. Thanks a lot, and all the best.
Yeah, thank you.
Thank you. Next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi everyone, this is Percy here. So first couple of hygiene questions wanted to ask. You mentioned that the foods sales was up 6%, but in primary terms it was -6, which means the inventory pipeline went up. So what was the reason for that? That is the first one. And secondly, if you could just give the rupees crore amount for the ESOP cost, which is embedded in the staff cost for this quarter, the full year FY19, and also what you think it could be in FY20.
All right. Percy, I'll seek Lalit's help on a couple of the second part of your question. I think the first part of the question is foods. The plus 6% growth that I talked about was the Nielsen data of the tertiary growth. So Nielsen indicates a growth of around plus 6% for real, while the category declined at around minus 2%. So therefore, there is a market share gain there. So that's a tertiary figure. As far as our figure, which is the primary sale invoicing figure is concerned, there we have a decline of around minus 5.9 on the foods portfolio for us. So there's always a gap between what the primary sales are and what the tertiary sales are, and that's the gap between the Nielsen. But I think what is more important here is to ensure that is the brand in great health or not, and that's indicated is through a market share gain. And we've seen around 450 basis points got added to our market share from last year same time. So we got a 56% market share, and that's what we've gained. So that's the answer on food. I hope I've been able to answer your question.
Yeah, okay.
And yeah, the second part, I think whatever I can't answer, Lalit, you can help me with it. So for the ESOP, the total amount for the year is around 77 crores, and for the quarter is around 40 crores.
So I think two aspects to this. So just to clarify, the incremental impact in the quarter, what Mohit is saying, is around 40 crores for quarter 4 and around 74 crores for the full year. However, if I were to just look at the last year's annual impact after eliminating that itself was approximately 77 crores. So therefore, if you can see, it almost got doubled impact on account of the reversal that we had. I don't know whether
sorry, sir. No, I'm not very clear on this. So 77 crores is the total ESOP cost in FY19. Is that what I should understand?
So,
Yes. Go ahead.
Okay.
Just to further add on what Mr. Malik said, total ESOP cost this year is 77.4 crores. Last year it was 3.5 crores, and hence the incremental is 73.8 crores. I think that was the question.
Right?
Yeah.
Because what happened is last year, similar, it will be around 77 crores.
Okay.
Around 77 crores.
Yes.
Going forward.
Okay. Now, next year also 77 crores, and Q4 was 40 crores, you said.
Q4, the differential cost was 40, the incremental cost was 40 crores. Incremental cost.
So what would be the...
Can I just, okay. Let me just clarify. In the year, financial year 17-18, we reversed 40 crores of ESOP. Therefore, the ESOP amount was much lower. In the current year, in view of the new scheme, the total annual ESOP impact is 77 crores, which happened to be only 3.5 crores in the last year, which is financial year 17-18. So therefore, the net incremental that got impacted in this year is around 73.8 crores.
Okay, understood, sir.
Going forward, it will be at the same level or maybe slightly lower because of the amortization basis that has been provided as per the standards.
Understood. So Mohit, next question is that when we had this analyst meet, I think about 8-9 months back, you had given a very nice presentation with a lot of sort of action points that were to be carried out over the next several months and quarters. So if you can just give us a quick update on what has happened on what you had set out to do as far as your journey is concerned, what actions have you taken, which ones are pending, and among the actions which you have taken, how has been the response for them?
Right. So I think that's a pretty long question. I try to give a short answer to this longest question, Percy. So I try my best, but I think we should have an analyst meet once again to address all the questions that Percy is asking. But I try to give you a succinct summary of the same. So I think first of all, let me touch upon categories. As I told you, the Dabur's got a very diversified portfolio and we are very scattered. So therefore, we wanted to consolidate this entire portfolio in the power brand architecture, to consolidate spends, to consolidate our initiatives and endeavors, and also to focus energies of the company behind some select 8 brands. So that architecture is already in place. Now coming to the investments to be made, we said that we will funnel all the investments behind these 8 brands, most of the investments, because they contribute to around 75-80% of our turnover. So we funneled the investments and we said that we'll do that. That has already happened. Category architecture has already happened. Third was the demand fulfillment. We had to change or reconfigure the way we were planning on the demand, which is all about media expenditure. Earlier, we used to follow an approach of CPRP, which is cost per GRP. Whatever we used to get cheaper, eyeball is eyeball, which was the basis of our planning, and wherever we were getting cheaper media, we were buying it. Now we are putting our money where our mouth is. So we selected out of 200 channels, we've rationalized those channels to around 50 in terms of number of programs. We've reduced the number of programs. So we are doing more impactful buys as against just media buys, which is actually reflecting in our market share gains in all the categories where we are present, which is what you've seen, whether it's hair care or it's oral care or it's juices or it's health care. Only in the areas where non-focus, which is home care and skin care, is where our market share losses are getting registered, but our growths are still 20% because we are investing there also. So this was the third part. The fourth part I talked about is go-to-market strategy. We said that we want to reduce the reliance on wholesale and therefore build infrastructure so that we can reach directly to the outlet. That was happened. As against 1.2 million is the outlet reach that we're planning to go. We were able to go to 1.1 million. We could not do a 1.2 million. I think next year going forward, we should be able to reach out to a 1.2 million target of direct reach. It was GT. Then fifth one is increasing the number of villages. So direct reach was more urban, then reaching out to more number of villages was more rural reach. That also we've embarked upon, and I think this is going to be a little longest journey. We find that around 66,000 villages in the total 600,000 villages in the country contribute to 50% of the FMCG business. So we want to eventually reach out to those 66,000 villages. So today we are reaching out to 44,000 villages. There is a journey to bridge this gap from 44 to 66. Next year we've taken a target to go to around 51,000 villages, for which we'll be strengthening our super stockist and sub-stockist network. The work is already started and we are moving towards that. The sixth element, if I remember, if my memory serves right, is the strategy of regionalization, in which we embarked upon a program called RISE, which was called Regional Insights and Speed and Execution. The regional insights meant that we have identified around 12 regional cohorts, and we are making those regional cohorts as consumer demand generating cohorts, looking at India like a mini India thing that Unilever has. So that is what we've embarked on. We've taken a test case of Northeast, which is where Tezpur, our manufacturing facility is, and therefore there is some sort of a tax benefit also if you sell in the same state, in the same region where you're actually producing. So we said we'll take it up a test case and see if we can do something with rice. We've seen a growth of around more than 25% coming in the Northeast, wherein we built infrastructure, we built in SSMs, we appointed sub-stockists, we took local celebrities, we took local newspapers, and we bombarded that area with regional communication also, which has given us great returns going forward. Now, going forward in the next financial year, we are embarking on South India as the second case for rice. South India for Dabur contributes to only 16% contribution to the overall business, as against other FMCG companies that contributes to around 25 to 30%. So there is a huge gap between what the potential is and what we are doing. So next year going forward, we are looking at South India, and what we've done in Northeast, we will be replicating it in South India also, looking at regional strategy for South India, and we think there's a huge growth potential there. So that is as far as rice is concerned. In line with rice, we are now creating P&Ls for every cohort. So there will be a top line and a bottom line, and we make the area heads who are responsible for areas responsible for not just top line but also bottom line, be mindful of what the bottom line will be, so that we are able to scale up the profitability in every region. There are our average gross margin on 50%, somewhere it's 45%, somewhere it's 55%. So there's a headroom which through analytics we've identified, and we'll be doing that. So pretty much I think I've been able to summarize on the go-to-market and on the brand area. The third area is capability building. We have recruited a lot of resources. First, healthcare was our focus. So therefore, we recruited a vice president healthcare in the company, or Rajinder. We recruited a healthcare OTC head for us. We recruited an e-commerce head. We've recruited a parlor head. So therefore, we've injected a lot of capability, which is lateral hired in the company to drive healthcare as a vertical. Then in the healthcare, we had to scale up some 3 brands I told you we identified, and I just narrated the results to you. Lal Tail and Honitus and Pudina, all 3 have been giving us great results. So I think we are on the right path fundamentally and structurally, and we will keep steering the course on our intent and not get really fretted by one-off results not being in our favor. So I think we are pretty much on the right track, and that's the way we'll steer the business going forward. And hopefully we'll be able to organize an analyst meet wherein we'll catch up with you one-on-one.
Great, Mohit. Thanks a lot for this detailed answer. All the best.
Thank you so much, Percy. Yeah.
Thank you. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good afternoon. Just two questions from my end. Firstly, on the juices business, or the foods business, can you break out between pricing and volume? And that will just give us better context on how the promotional activity played out.
So the volume decline was around 4% as compared to the value decline of around 6%.
All right, and the rest was the rest is pricing. So there's no impact of any adverse mix or anything of that sort.
Not really.
All right, and secondly, in terms of margins for you mentioned that e-commerce and modern retail are growing much faster. Is there a difference in the margin profile there and also on working capital?
So I think in terms of margin profile, e-commerce and modern trade are actually accretive to the business because we try to reach out to the modern trade directly, and that's what we are embarking on going forward. So we are trying to eliminate the intermediary between the company and the modern trade big chains and trying to deliver them directly. That's a supply chain that we're bringing about. But as such also, if you include the intermediary in between, our margins are accretive because what you sell in modern trade are large packs, and large packs invariably have a higher margin as compared to the LUPs which go through the GT. And also in e-commerce, all the platforms focus on higher ASPs, which is the average selling price is generally higher. So they are not interested in selling lower ASP product because the cost of freight is very high for e-commerce. So therefore there also the profitability is fairly high as compared to our regular business.
Understand. And just following up there on working capital, are there any meaningful differences or nothing? What do you think?
There are no major differences on working capital.
I think working capital is actually favorable because you're directly going out there and selling it, and once you sell the goods, it becomes their property, and working capital actually benefits us positively there also. So, but in some modern trade chains, I think the credit is going to be a higher. So
it's not very significant.
You're right.
Understand. And lastly on that, all the sales to the modern trade channel, are they done directly or do you go through intermediaries?
No, today it goes through intermediaries. The intent is to go directly for the major ones. You can't supply all the modern trade customers directly, but as we scale up the business, who becomes big customers, we are trying to go direct with them. So we are in the process of negotiating margins for us to supply, and it's meaningful for us to supply them full container loads or full truck loads directly. Where the customers are subscale, where there we go through a stockist.
Understand. Very clear. Thanks.
Thank you.
Thank you. Next question is from the line of Amit Sinha from Macquarie. Please go ahead.
Hi. Thanks for the opportunity. My question is again on the food segment, and if I look at, and barring this quarter, if I look at the last 2 years' performance, the segment has underperformed the other segments. So the question is, and you have gained market share, so you have done specifically well within the overall segment. So the question is, for the overall category, are you seeing competition from dairy-based RTDs? And is the overall growth in the category supposed to come back to double digit in the near term?
Yeah, so I think your question is right. While the competitive intensity is only hotting up in the category, and we are getting aggressive and we are gaining market share, we steer the course on the strategy of gaining market share in the beverage, but dairy is definitely giving us competition, and the growth rates are also higher in milk-based and yogurt-based products because the base is very small there. So we are trying to recalibrate and rethink our strategy on where to go and where to focus. But the margins are really dilutive in the dairy, and it requires a back-end capability also. So as of now, there is a reluctance, but we feel that there is enough headroom within the JNN category and the juices category also to take the business forward. When I talk about 56% market share, we are operating in a 1,600 crore category, which is the JNN category, which is juices and nectars. The moment you expand this pie and go to drinks also, where I think the real headroom is and where the equity of real lies, we suddenly start operating in a category of around 6,000 odd crores, whereas the overall pie, if you include the dairy also, it could be 10,000 odd crores. So I think we have enough headroom for us to go before we embark on dairy or anything like that. So I don't think there is a limitation in terms of the headroom, or there is so much of competitive intensity that the future looks bleak for us. I think it's all contingent on the kind of innovation that you launch, and that's what we've done. We launched the entire masala range, which is doing exceedingly well for us. Now we are extending it, and going forward also you will see a step up in the innovation in the juice category, which will fuel the growth within the JNN space and JNN and drink space.
Sure. Thanks for the detailed answer. The second one is on your overall strategy. And when I look at your overall market share gain strategy, it is very, very visible and is very encouraging. However, at the same time, we have also seen Dabur being very aggressive on the promotions and very active in the lower price points SKUs. So the question is, does this strategy also put margins under pressure, at least in the near term? And while you have answered a question related to margin, that you will protect the margin, but my question is that can we see a margin expansion in this kind of an aggressive strategy which you have undertaken for market share gains?
See, we don't have an intent of taking up the margins forward. I think we are at a good level of margin. If you want to protect the margins, we want to have a stable margins actually going forward. But as far as strategy is concerned, it is a two-pronged strategy. The growth is going to come from premiumization, as I told you. Premiumization is margin accretive, but there is a limitation on the volume of business that you can get out of it. So while there will be margin, the volume of business will not be there. Whereas the LUP, which is bottom of the belly, which is scalable, so there also we will have to embark upon. You can't have one strategy and not have the other. So I think one is a volume driver and other is a profit driver. Both have to go hand in hand together. So there will be premiumization on Dabur Amla. Also there will be LUP strategy on Dabur Amla, which is going to be a 10 rupee price point or a 5 rupee price point or a sachet price point. At one end in shampoo, you will be investing behind the bottle, and the other end you will be investing behind the sachet also, which is the belly of the market. At one end you will get the volume, and the other end you will get the profitability, and you will drive innovation and projection and more premiumization and connect with the millennium through e-commerce. So it has to be a hand in hand. I don't think this will put a pressure on our margins going forward. If you don't do it and it's skewed towards one end and only on bottom of the belly, then it can put pressure. But if the volume and the scale of business goes up, it will only leverage the cost, and therefore it will flow down, and the operating margin can also be maintained by way of having a scale through LUP in volume also.
Thanks a lot, Mohit, and all the best. Thank you.
Thank you.
Thank you. Next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi. I had just one question. This year, in the 4 quarters, we have seen a lot of volatility in the volume growth at the domestic level. So I wanted to understand, is this volatility largely due to base effects in different quarters, or have you actually seen substantial acceleration and deceleration in the alternate quarters this year? And, linked to that question is, as you go ahead, do you see this volatility kind of come down, or and has there been any trade pipeline related, reasons for this volatility to be there?
No, Arnab, our business, as I told you, is very diversified, and there are seasonal variations during the whole year. So I think season plays a very big role in our business. For example, Chyawanprash business, healthcare business is pretty much skewed towards the winter. Juice business is skewed towards summer, and there are some gift pack business which is skewed towards the festive season. And the calendars keep varying and the seasonality keeps varying, and that's how the volume actually surges or it actually takes a dip. But I think fundamentally, there is no issue on the volume business. Neither have we built in the pipelines at all. We are very mindful of the hygiene to be maintained at the trade level. We operate at a 15 to 20 days of inventory at the stockist level. That's where we guys are. Our intent is to actually cut on the pipelines going forward further. If you see, our inventory levels have also gone down from last year to this year, and we've also embarked on a supply chain project in which we are looking at range availability at the distributor level, which would bring down the pipelines at the distributor level also, which we corrected our depot level inventory. Now going forward, we will correct our stockist level inventory carefully so that it doesn't impact the business also so much.
Right. Okay, thanks. And the second question was on hair oils, because you mentioned this as one of your priorities for next year and one of the major priorities. So this market share gain that you have done this year overall in hair oils, what has actually been the sources of this? Has it been more driven by your approach on coconut oil, or it's been more driven by amla and other oils? And in terms of next year, I mean, how do you want to kind of grow this category for you?
Yeah, so to us, hair oil business is definitely a potential. As I told you, we are only 1,200 crores in the category size, goes up to around 10,000 odd crores, and we see a huge headroom for growth here with one or two single players in every sub-segment here. So therefore, there's a lot of potential in the category. Now, the strategy that we have put in place last year is, first of all, is the revival of Dabur Amla franchise. We've got more competitive in terms of media, in terms of our communication, in terms of our go-to-market, but some structural changes in terms of modernization, which are time-consuming, which we embarked upon, but which hasn't seen the light of the day, will be seen going forward next year. We have revamped our complete packaging of Sarso Amla and Brahmi Amla, which are our flanker brands. So our strategy of building moats around our pillar brands is kind of reaping dividends going forward in the future. So we've got moats in terms of flanker brands like Brahmi and Sarso, and we've seen great volume growth coming from there. Dabur Amla also is back on growth path, as we see it's an expensive brand, and we see a growth path back on Dabur Amla also. In terms of coconut oils, our initiatives of launching Anmol Jasmine is doing reasonably well. And next will be revival of Dabur Vatika, which is what we'll embark on going forward next year.
And just on the market share, so within Amla also, have you gained market share, or is the 70 bips more driven by the the coconut oil side?
No, in the overall perfume hair oil segment, we've actually gained the market share. So I think I club the Amla franchise, Amla along with Brahmi and Sarso, we have definitely gained market share, despite we sitting at a premium to our competitors.
Sure.
And premium of 50%, no less there.
Sure. Thanks so much, and all the best.
Yeah, thank you very much.
Thank you very much. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. Just had three questions. Firstly, on the competitive intensity or promotional intensity you spoke about, it seems like Q4 has even been higher than Q3. So just wanted to understand, specifically where has the promotional intensity, which categories has it stepped up?
Right, so promotional intensity has been there across some segments. I'll name some of them. First of all, is fruit juices. I think in juices, the competitive intensity is really gone up with a lot of competition coming up along with dairy and also yogurt-based drinks, and therefore 10 rupee price points are actually hotting up. That is one area. Second is on Amla, competitive intensity, on hair oil, competitive intensity remains what it is. In oral care, competitive intensity is kind of abating. We saw earlier a lot of freebies happening by our competitor, but we see that in oral care, competitive intensity is actually coming down. In healthcare, we don't see much of competitive intensity. In home care and skin care, there is a fair bit of competitive intensity in home care by lead players, and in skin care by small economy players, who are chipping away our market share. In healthcare business, the only area that we've seen a step up of competitive intensity is in the case of honey, with small economy players who are mushrooming, which are very small geographical players. So I won't even call it a competitive intensity. I think very small regional players coming and discounting the products and chipping away market share. But we have to be, circumspect of it and quickly, through tactical promotions, tackle that issue so that our market shares don't decline even in pockets. So that's the overall picture. But I don't think it's really gone up to an extent that we can't combat it.
Very clear. So very clear. The second thing was on the rural-urban kind of outlook. If you could just give a sense of, how much probably in terms of even qualitatively, how much rural would have slowed probably for the last couple of quarters for you, and how you're seeing things going forward on that side.
See, in the current quarter, we see a growth of around 7.8 coming out of rural, and urban is growing at around 7%. Now, the gap between urban and rural is drastically come down. Earlier, we saw a gap of around 30% higher rural growth as compared to urban growth. Now, it has come down to around 10-odd percentage level. So, we see pressure. But that being said, the rural is still firing at a much higher pace as compared to urban. So once the government stimulus actually flows in and the sentiment actually improves post-election, that's what we are hoping. And we've got a great infrastructure put in place for rural, and we are able to launch accessible price points which can ride our infrastructure. We think rural will give us great benefits going forward. So we are pretty optimistic. Our rural alliance is more as compared to our competitors. Our 45% of our sales happens from rural. So we think rural resurgence will happen behind all the promises in the manifestos by all the elections. So there will be rural money. There will be money flowing into rural India, and there will be demand resurgence happening there and some rev up.
Very clear, sir. Very clear. The last thing was on the margin. So when you speak about not, looking to maintain margins, you're speaking more about the India business, right? Because I assume that there is some scope to improve the international margins given the weakness this year.
Right. So international business is more faced with the geopolitical and macroeconomic headwinds, like Lalit mentioned previously. There are currency depreciations which hit us from all quarters, and currency depreciation then hits you both at the transaction level and also at the translation level. At the transaction level, when you import the goods, there it becomes more expensive because you buy in a dollar-denominated currency, and therefore it puts a pressure on your bottom line, and this you may not be able to pass on to the consumer. So that pressure will be there. That being said, there is a category pressure also to top it all. Therefore, we've been giving a lot of trade scheme, but we look at improvement, small improvement or maintenance of the margins as going forward as the situation improves after this quarter. So we expect maintenance of margins and a growth rate in margins also in line with the top line.
Got it. That's it from me. Thanks and all the best.
Thank you.
Thank you very much. The next question is from the line of Rohan Gandhi from Anand Rathi. Please go ahead.
So you mentioned the growth of modern trade channel 19%. I missed out on that. 19%, right?
Yes. Yeah. Right. Correct. 19.
Yeah. Okay. Thank you.
Yeah. Thanks.
Thank you very much. The next question is on the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, you seem very clear on your margin outlook. Basically, you want to keep it static to revive growth. So, with this kind of goal seek, what sort of growth trajectory you are targeting with?
See, we are looking at a high single-digit volume growth, and to offset inflation, we are expecting inflation in the range of around 2 to 3%. So, overlaying 2 to 3% price increase on a high single-digit volume growth is what is our outlook that's our target for the next year going forward for the India FMCG.
Sure. So second, when I look at your performance and your commentary where you are attributing a lot of this weakness to seasonality factor also. So is it that in this quarter as we speak, the underlying demand momentum is not as bad as it appears from the number, it has revived, or it's a combination of both in fourth quarter's number?
No, I think what you're saying is right. We see a little bit resurgence in the demand because we had a severe winter, and after a severe winter, we expect a normal sort of a summer, if not very severe, and the monsoon is also going to be near normal as the data speaks, as the rabi crop has been good. So we are actually seeing 1 month has already elapsed for the quarter, and we see a little bit of revival in the demand in the month of April, and hopefully it will continue going forward in May and June. But we have a high base of last year in which we registered a 21% odd growth, so we are mindful of that. So it's a tall task to have a very high single-digit volume growth also on that base of around 21%. But I think going forward next quarter, hopefully things should get better. Yeah.
So lastly, in NPD pipeline, are you taking a call of becoming category creator also in some of this new products, or as of now will be mostly around renovations and perhaps will at best will play a role of challenger in some of the established categories?
So as I told you, it's a two-pronged strategy. There is a strategy for the bottom of the pyramid and the belly of the market, and there is a strategy at the premium end. At the premium end, we will play a role of a category creator, and that's where we will launch formats which are perhaps new to India, and we've already done that in the personal care space in international business. So we have a learning from there, and we can bring those products, curate them at the e-commerce platform and see if they have any traction. Then we can roll it out in the general market and in the mainstream. At the bottom, we will play LUP game, making the price points more accessible to the consumer. The role of innovation there will be low at the bottom of the market, but the role of category creation will be high at the premium end of the market.
Great.
So both ways.
Thanks and all the.
Thank you very much. Yeah.